Good morning, everyone. So, a very warm welcome to all of you on this 11th edition of Global Udan webinar series, an initiative of the Development of International Trade Services and WTO Directorate of ICI. So, it gives me immense pleasure here to have you with us today. You've all joined uh, for the continue our journey to empower Indian chartered accountants to global opportunities. And that is what the theme and objective of these Global Udan webinar series. So this is the 11th series we have done so far, and this being the 11th, 10 have been successfully completed. And I sincerely thank all the participants who have been joining us in earlier webinar series and who've continued to support us on this webinar initiative, which we have taken under the Global Udan. So already 500 plus members have joined. Very important session today is focused on a highly relevant topic, I must say, which is US business setup and recent tax update. We all know the United States remains one of the most dynamic and sought after destinations for business expansion and professional services. More particularly, I speak about the accounting and the financial services. And if I relate to the accounting and finance services, which is now coming from US to India, definitely outsourcing is one important area which is now coming from US. We have started a certificate course on outsourcing services. The ninth batch already announced starting on 7th of July and 30th being the last date, and already have an excellent response for members who have already registered. So this outsourcing certificate course really helps the members to upgrade, to upskill themselves for the opportunities which is now coming from the US market. And to add on to this, we are looking at the opportunities at the UK market, where again we are looking and starting a certificate course very soon in the month of July for UK market and going forward at the Australian market and other locations which are no matter what be the locations, but the work which is now coming from global is tremendous. As we all know, globalization, is very important. And for us to know the business setup, the recent updates which are there, the regulatory framework at the US, the business environment, the tax landscapes, very important as a professional because we're getting a lot of support and established, which I'm sure the experts would let us know. We are privileged to have with us CM Manish Agarwal ji, an expert in US taxation and business structuring. As an esteemed speaker, thank you, Manish ji, for accepting our invitation and making yourself present for an important session today. This would really be enriching. I'm sure your level of experience and understanding would be very insightful for the members, participants who are here today. Also moderating this very important session, CA Atulji. Thank you, Atulji, for joining. A seasoned professional with vast international exposure. We thank you for being here, accepting our invitation, helping us explore the topic both from strategic and operational perspective. Once again, I welcome all the participants who are always encouraging, ensuring that this Global Udan webinar series continue to be a big success for all of us. And I'm sure we'll have an excellent learning about the US market, the updates, the taxation updates, which are relevant for us. And I request members to please continue support. Please join to our webinar series and also request all those interested members to please register for the certificate course. The last date is 30th of June. And I'm sure if you see the content, the structure, definitely somewhere is an opportunity which now is coming to India. So thank you once again, all of you, for joining. And I wish this 2 hours will be a happy learning for all of us. Thank you very much. Over to you, Atulji.
Thank you very much, Vijay. Good morning, friends. A very warm welcome to this technical session on business setup in USA. So, why USA specifically has been chosen for this technical discussion? Today, businesses are not restricted to a particular territory or a particular country. With the expansion of the global business dynamics, it is the every business has an aspiration, or every entrepreneur has an aspiration to go beyond the boundaries. So whether it is beyond the Indian soil or whether it is beyond the Indian territorial waters, every individual, every small business house or MSME, we are looking and we are experiencing a lot of influx where there is an outbound investment which is happening now. or they want to test the waters outside India. So with this as the background, where we will do some threadbare discussion related to specifically related to the US market, where there are multiple questions. Say when an entrepreneur or a professional firm or a service firm or a goods manufacturing firm want to test the waters outside India, what are the nuances, whether it is related to structuring, whether it is related to the legal entity, whether it is related to the tax implications with respect to the investment and also the regulatory framework from both from India perspective and from the US law perspective. We will be focusing specifically on US in this session because that's the theme. And so the many questions will be there with respect to what is the best structure possible to start, what is the best most tax efficient mechanism to have a legal entity in US, what which should be the shareholding pattern or what should be the ownership, considering all those facts and also keeping in mind the Indian tax laws with respect to the treaty between India and US and specifically related to the POEM rules, place of effective management, which is a very serious implication now when you do an investment into a foreign company from here, when you set up a wholly owned subsidiary outside India. So there will be multiple questions, multiple thoughts which will be there. And we have Manish with us today, who will be taking us through the entire journey. He has been working on the American clients for a very long time, has a great experience on this. And so he will be sharing his thoughts and experiences on this entire concept. And after his presentation is concluded, we will have a panel discussion so that I can take care of your questions from the audience side also, so that we have a good participation and have an interactive session. So I will be representing on your behalf for any Q&As which will be there, and I will be taking over with Manish independently on this. So over to you, Manish, and look forward to a technical discussion first as a representation from your side on the India US on the business setup in USA.
Thank you, Atulji, and entire ICI team and uh, Abhayji for this introduction and giving an opportunity to participate and speak for this very relevant session as highlighted by Mr. Atul. So I'll be sharing my screen. ICI team can just let me know if my screen is visible to everyone. I hope it's visible. Okay, so as Atul said in the beginning in the concepts, like why US and why do we need to discuss upon the US? I'll just take a few minutes and would not take much time, and we'll straight away move to the technical decisions. But so many times nowadays we get queries as I'm talking more from a point of view, our audience from a professional's point of view, that their client wants is an NRI or a global citizen or a global businessman, and they want to, having tasted success in Indian market or other market, they want to obviously naturally expand to the global market. And few countries are very prominent at that came into the client's mind, like US, UK, or some European market, that they want to expand into that particular market. Now, obviously, when you are your client's trusted advisor, the client often comes to you that, okay, you are a tax expert of me. What's your view on setting up a company in US? What are the types of companies in US? Which is the most efficient kind of a structure in US? In which state I should incorporate a company? What are the business, payroll, or individual related tax structure in United States? So all these questions comes to the mind of client, and this is what they would ask to you as a general principle. Now, if we don't have this level of basic understanding or knowledge, I'm not saying that we should be a US tax expert and leave our practice, but of course, if we want to be a global tax advisor and continue advising the high net worth or a good set of NRI clients, the knowledge of these concepts and the taxes and the regulatory system is imperative. And this is the whole objective of the webinar, that we should be focusing more on a high level overview of a US corporate structure and the taxes around it. Obviously, 1 hour time or 2 hour time is not enough to deep dive into each and every concept, but the idea is to give you a flavor of what all things you should be put into place, and can have a deeper look later. But yeah, it would be a good starting point as a flavor. So the first question obviously is that when you want to start a business, your client comes to say, okay, uh, whether when I'm required to start a business in United States, do I need to have a green card or a citizenship to open a business in US? So the answer to this is that no, anyone can open a company in India as long as you file the relevant documents with the state registrar or the secretary of the state, and you are not required to have a residency permit or a green card or a citizenship to be a shareholder in a US company. But there's an obvious caveat here that in order to be physically working in United States, you need to have the relevant business visas or the treaty visa, because you can be a shareholder in a company, but in order to be physically present and work in the company, you need to have the relevant visa and comply with the visa regulations. So that's one thing. Now, the other important is what are the business entity options? Like here in India, we have LLP, private limited company, partnership, sole proprietorship. So similarly, in the United States also, we have different forms of business options. They are called C corporation, which is a C corp, S corporation, LLC, sole proprietorship, a general partnership. So we know why this decision of selecting a business entity is important, even when somebody wants to enter into Indian market or maybe globally, because the choice of entity determines your key business outcomes in the future, like how your entity would be taxed, what would be the nature of compliance. Let's say in a company, the compliance requirements are more compared to a partnership or a proprietorship. It also determines your future funding. Let's say in partnership or in an LLP, the future funding is constrained, whereas in a company, the scope of future funding or bringing on to the more investor is wide. So, and also you want to determine your shareholding or the capital table structure, which is called cap table usually. Like in a partnership or an LLP, it's limited. You generally bring in because the ability to add more partner is quite constrained in partnership, whereas in a company you can add more shareholders with just a share transfer or issuing additional shares. So, and also the ownership, the transferability of the ownership. So all these important business factors from a finance and tax point of view are relevant when you decide the business entity in United States. So particularly if I talk about uh, uh, non-residents from India, I mean, non-resident means US non-residents, and let's say an Indian resident wants to open a business entity in India. Typically, what in our experience, we see they opt for either a C corporation, which is like a regular company, or a LLC, which is a partnership with a limited liability and features of a company. We'll deal more what is LLC. So these two are generally structures followed. And there is another third one, which is S Corp, but it's usually not adopted by Indians. Why? Because S corporations have a requirement in the United States that they need to have all the shareholders as US residents or a US permanent citizen. So being an Indian resident or Indian citizenship holder, you may not be eligible for a S corporation. So that's why we say that C corporation or LLCs are typically constituted in United States as a business entity option. So let's see now more about the C corporation. A C corporation also referred to as general for-profit organization. So there is a not-for-profit organization and a for-profit organization. Similarly, like in India, we have a private limited company and a Section 8 company, which is a not-for-profit company. So C corporation is a private limited company or a for-profit organization, you can call it. And in C corporation, it's a limited liability company wherein the liability of the shareholders or the promoters are limited to the extent of the amount they have individually invested in the company, compared to a proprietorship or unlimited partnership where the liability can go even to their personal assets. And very important, C corporation, like in India, the companies have a dual taxation system wherein the profits of the company are first taxed in the hands of the company, and then distributions made from the company are taxed in the hands of the shareholder as per their individual tax rate. So similarly, C corps are also subject to a dual tax structure, wherein first the corporation pays the tax and then the individual shareholders pay tax on the distributions they receive from the corporations. And the last note is that the C corporations, obviously, there is some level of formalities and compliances that you need to do, but ultimately it's better the cost versus benefit analysis if you do between a unincorporated business versus a incorporated business. Our recommendation would be always to go for a incorporated business because it gives you a legal identity to do a business in India. If you're expanding into US, partnership or a proprietorship is not usually a preferred option because you don't get a legal entity or a separate identification of the company. The next business structure is LLC, which is called Limited Liability Company. So it is often called as a hybrid entity structure wherein it has a feature of limited liability like a C corporation, but it has a tax treatment like a partnership or a pass-through treatment. I'll explain. So in LLC, it can be a single member LLC or a multi-member LLC. Single member LLC means like a one-person LLC, and multi-member means there are multiple partners in that LLC. So and their liability is limited to the amount of their capital in the LLC. But in LLC, from a tax point of view, LLC is treated as a disregarded entity. Disregarded entity means that LLC does not pay tax on its own. Whatever profits of the LLC, they are taxed in the hands of the partners of the LLC in the proportion of their profit sharing ratio or the allocation ratio that they have agreed in their operating agreement. So this is you get the best of both the worlds here. Like you get the liability protection like a company and you get a tax treatment as you want indirectly. You avoid the dual tax structure. But in the US law, LLC are also provided with a flexibility to opt for a corporate like a tax structure as well, because in some cases, corporate tax structure like a dual structure would be beneficial, wherein the partners don't want to get taxed in their individual hands for the profits of the firm. So you can also elect for that. And this is called as check the box election. You would have always frequently heard of this term called check the box election. So this is the check the box election wherein LLC can elect to be taxed as a company instead of being a partnership or a pass-through entity. So by default treatment under the law for the LLC is a disregarded or a pass-through taxation. But by filing a check the box election, you can opt for a corporate tax treatment. So here is the brief bird eyes view of LLC and C corporation. LLC formation, I would say both the state filings are required. So state filing means you need to draft your incorporation documents and registered with the Secretary of the State. So just I would repeat again in the later slide, but just to say, in the US, the company formation is a state subject, unlike in India, where the company formation is a centralized portal over there. In US, all the in whichever state you want to incorporate a company, you need to deal with the state authorities. There is no single federal company or registration authority in US. As I said, in both LLC and C corporation, the liabilities of the owners or the promoters are limited. Transferability of interest, it's high in the C corporation, but in LLC, it's limited because it's a closely related affair. So obviously it's limited there. Duration, okay, it's unlimited. Members may come, members may go, but the entity will go on forever. So by default, it's created for a unlimited duration. Pass-through tax statement, in company, it's not there because in company, it is always a dual structure. In LLC, as I discussed, pass-through tax treatment is a default tax treatment, but corporate tax treatment can be elected as well using the check the box regulations. Ability to raise the capital, I would say you can raise capital in both C Corp and LLC, but beyond a point when you want to raise capital and get more investors on board, C Corp is preferred. Again, there is no limitation on the number of owners you can have. There is nothing such kind of a regulation. Now, what are the initial filing process, I would say, and the recurring compliances? So both in C corporation and LLC, you need to do a initial filing, means you need to file your incorporation documents, your bylaws, articles of associations, article of organization. You need to maintain your operating agreement and bylaws as your internal documentation. Annual compliances are there, like you need to file the annual reports with the Secretary of the State, and this is generally as a part of the franchisee tax. In C corporation also, you need to have the meetings, like in India, in private company, you need to have the board meetings and minutes. So similarly, you need to have the board meetings, annual meetings and minutes. And registered agent is also required to be appointed. So registered agent is nothing but a like compliance agent who maintains your company in good standing with the registrar and do all your compliances, receive the correspondence from the registrar. So we'll see the concept of registered agent as well in the later slide. So this is a high level bird overview of the business structures in US, their comparison. Now let's see some of the corporate bylaws and what is the operating LLT. So corporate bylaws are as good as like articles of association in India where we have. So it is like an internal documentation of the company which contains the governance framework of the company, like how the decisions are to be made in the company, how many directors should approve it, whether it's to be approved by a simple majority, 2/3 majority, or a special majority. What are the roles and responsibilities of the directors? What is the process of removal of the directors? So, I mean, stuff like that. So it's pretty admin, but yes, it's called the one of the important charter document and the governance document of the company. Similarly, like in a corporate, for LLC, it is called as LLC operating agreement. It also contains the governance framework of the LLC, wherein it lays down the basic tenets, like who are the partners, how the decisions are to be taken, the profit sharing ratio of the partners, the capital ratio of the partners, how the decisions is to be taken, under what circumstances the business will dissolve, or if a member wants to take an exit or retire, what is the process that needs to be followed. So it's more or like a partnership deed in India, but yes, you need to follow the certain convention from a United States law point of view. Now, from a tax point of view, where do these two structures stand? We'll see very briefly tax advantages and disadvantages for LLC and C corporation. So C corporation, it should not be advantage, but it should be a disadvantage. So C corporations profits are taxed, is a double tax treatment, as I would say that once it's taxed in the hands of the company, and the second time it's taxed in the hands of the shareholders of the company. So depending on the particular situation, it may sometimes turn out to be a disadvantages, wherein let's say the C corporation tax rate in a company is 21% and the individual shareholder rate is at a highest bracket of 37%. So in this case, you get hurt at highest rates, so it may turn out to be disadvantage in some situations. And sometimes corporate tax rate may be favorable because let's say a C corporation category. So as I was saying, so in some cases, the double tax treatment may be beneficial for the reason that let's say the individual shareholder is at a lower tax bracket. So in that case, the individual is taxed at a lower rate, reducing the overall tax burden for the company. So depending upon the shareholder's personal tax situation, that what is in which tax bracket he fall, let's say he may have a loss situation or something, they might find that corporate rate will cost less compared to LLC. So in LLC, the individual is taxed directly in his hands as per the applicable slab rates to an individual. Whereas in C Corp, it's double pass, like first taxed as a corporate and then taxed in the hands of the individual shareholder. So when you do a comparison based on the slab rate at which a particular individual sits and the amounts of the dividend or the distribution and the profits, you did a scenario analysis, and sometimes it's favorable for a company because let's say overall tax burden for an individual is 31%, whereas for a corporate it's just 21%. So you may feel that still the overall tax burden is low in a company versus LLC, and the reverse may also hold good. So depending on the modeling and the individual tax situation, you need to determine whether a LLC is better or a double tax treatment in a company is better. And there are certain tax deductions which only a C corporation are entitled to, but not the partnership. So some of the examples are like energy efficient credits, employment taxes, payroll remuneration, whereas in LLC there is no concept of payroll or something like that. So you need to be mindful of these. So LLC, as I say, there are certain tax advantages for LLC. As I say, depending on the tax situation of the share or the members of the LLC, sometimes LLC's pass-through tax treatment may be favorable compared to the corporate tax structure. And LLC also offers the partners a flexibility to divide the profits, because in company it is always divided based on your individual capital ratio or the shareholding you have. But whereas in LLC, the ratio for the capital and the ratio for the profit allocation can be different. You can choose a different ratio, not just the capital, but also the time and effort, because although there are, let's say, three partners, they have invested equally, but one of the partner is doing the main business. He's the CEO kind of, he's leading the business, both business wise, operation wise. So he said that I should be entitled to more profit. So you can have this kind of a flexibility in your LLC operating agreement from a tax, and tax wise also it is recognized. Now, what is some of the disadvantages of LLC? One disadvantage is LLC need to pay the self-employment tax. So in US, there is a concept of self-employment tax, because LLC in the eyes of the law is basically just a partners, individuals doing their own business. So and since individuals doing their own business means you are into your effectively self-employment. So there is a self-employment tax also. And LLCs and obviously, since it is considered as that the business is done by the individuals, individuals are also subject to social security taxes like Medicare and Social Security. So these kind of taxes may sometimes create extra tax liability for LLC. And in company, let's say, even if you are owner or a shareholder, you can still be a director and draw the remuneration which is tax deductible. But in LLC, you cannot do this. A member of an LLC cannot be an employee of an LLC. Now, the very important question another is like once you're decided what kind of entity you want to formulate, like LLC or a C corporation based on your tax modeling and scenario analysis, you want to know that what is the state in which, as I said initially, that in US, every state has different rules. And in US, the company formation is a state subject, not a federal subject. So what kind of a depend, so which is the optimal state for business corporation becomes an important decision. So generally, uh, being a non-resident, uh, you need to see, there are some factors which you need to see, like firstly, the overall business environment of that state, like how are the laws and regulations of that particular state, particularly are they friendly for a foreign direct investment or non-residents point of view, whether how much ease it is to form a company, transfer a stake, take an exit, and to expand the business if I were to uh, choose that particular state for forming my company. And then the other important point is how much uh, annual cost of maintaining the business is there. What am I supposed to do? Too much compliances, too much tax returns are there. So this is the one factor. Then the other is, are there any incentives in the form of taxes or credits that are available if I select to form an entity in that particular state? So these are high level indicators or variables that you need to analyze when advising your client in which state you need to form your company in United States. So popular one, as you all know, would be Delaware, Nevada, Texas, California, Wyoming, Florida is also coming up. So these are some of the popular options. And as I said, what are the variables that you need to consider? This is a quantitative variable. Let's say how much is the formation fee? Let's say if for some states like California and Texas, the cost of formation is high, whereas in some states it's low. So it depends. What's your client's preference of formation? If he's looking for a low cost or a low maintenance state, you can go for Delaware or Wyoming. Whereas if the client is looking for a state known for its repute and business uh, integrity and which commands a high premium, states like California and Texas are there. Then again, the variables like annual fees, franchisee taxes. So these are high in states like California and Texas, but low in some states like Delaware and uh, Wyoming. Obviously, also New York is a state which is very expensive, but yeah, uh, if your address has a New York address, obviously it commands a better respect in the market compared to other jurisdictions. So it depends on the overall business perception and your goal as well. The other is the legal and court system in that particular state. How speedy is the dispute resolution process in that particular state? And tax intensive in the form of state income taxes. Some states do not levy. So in US, uh, the income tax is also a federal and a state subject matter. Unlike in India, where income tax is a central government levy. So in US, there is a 21% federal levy on the companies. And then each state has its own state tax regulation. Some states levy, some states do not levy. So some of the states do not levy, so we can consider that states as well for the registration of the company. So I made just a very brief comparison between two of the very popular states which offer uh, tax incentives and which are very much known to Indians and all over the world. One is Delaware and one is Nevada. So Delaware has the most developed and for so apart from tax system, it has very flexible and developed corporate law. So corporate law means it if you were to take a different kind of a shareholding structure, or you want to bring multiple capital, or let's say you want ease in doing M&A, or you want to do a cross-border M&A. So sometimes uh, the corporate laws also play a part in determining the state of company formation, and Delaware has the most advanced and developed or concepts in its corporate law statutes, and it is considered as very pro-business and ease of doing business point of view. And if you look purely from a tax point of view, let's say uh, uh, Nevada is one state which has no income tax on state corporate income tax, no personal level income tax at that state, no annual franchisee tax, low filing fees. So obviously Nevada is because, and that's the reason why we have some of the most prominent hotels over there, because Nevada initially used to be a desert state, and to promote investment in Nevada, they offered these incentives. But obviously it's no more just a desert now. It's home to the largest casinos and the other hotels in the world, and one of the most popular tourist destinations in United States. So a general rule to remember is if a business is incorporated in one state, but the owner lives and conduct business in another state, they are responsible for state taxes and fees in both locations. So let's say I am a, a resident of mm, uh, let's say New York, and I do business in both, let's say Miami, and let's say some other states, let's say Chicago, then the I would be liable to pay taxes on each of the states which I am conducting business, and not just the state in which I am registered, because the state in which it is registered is just a, a legal purpose. But even if you're doing business outside your state, you would be still be liable to pay uh, state fees and taxes in the different locations in which you do the business. And general thumb rule is that if you have fewer than 5 shareholder, it is more advantageous to incorporate uh, in the home state of the shareholders. It's generally preferred. But obviously, if in a cross-border situation, this is generally not relevant. But this is relevant if you have, let's say, US residents and shareholders also as a part of a company process. Try to register in a state in which the person is resident of. Now, what are the high level steps that you need to you know, follow where to set up your business in United States? The first step is obviously, even when we do a company formation in India, it's like you get the name approved, decide the name from the MCA or ROC. Here it is called the registrar or the secretary of the state. Then you appoint a designated agent. So a registered agent is like a person who coordinates on your behalf with the secretary of the states, like doing all the correspondence, receiving the documents from the authorities, answering to any clarification. And also sometimes you can use the address of the registered agent for the purpose of the registering your business. Then the next step is you draft your charter documents, which are called articles of incorporations or articles of organization for LLC. Then you obtain your statutory registration numbers, which are called employer identification number. And then simultaneously you draft your operating agreements or bylaws and get the bank accounts done. And also, if you are in some business which require licenses and permits, you need to open get some specific state license and permits. Let's say you are in the business of a casino business, you need to have the relevant licensing requirement from the state gaming authorities. Or let's say if you are into business of, let's say, financial service or a stock exchange, you need to apart from the company formation, you need to have a license from Federal Reserve, which is your US, like an RBI equivalent of the US. So depending on the type of business, like financial services, or if you're opening up, let's say, a manufacturing plant in that space, so you need to have the fire licenses, building permits, construction permits from that particular relevant authorities of the state. So depending or let's say if you're doing a trading business of the food, so you need to have the approval from the Food and Drug Administrative Authority, FDA approval, or a medicine business. So depending on your type of business, you may be required to have the licenses and permits in place. Then, as I was saying, that the registered agent, a registered agent is sometimes referred to as a resident agent or agent for service professor. His role is to, and he's like an officially recognized person, and his role is to accept service of process on behalf of the business. So basically, act as a licensing officer between you and the Secretary of the State. And the registered agent person must be a natural person. He must be having the business office in there. He cannot be a post office or just a shell office cannot be used. It has to be a actual business person over there who has a physical office and presence there. So articles of formation, which I said are the charter documents for LLC or a company. They are called articles of incorporation for a company, and articles of organization for LLC. And these are the like so articles of incorporation is received when you are officially given a registration by the Secretary of the State. Upon filing, they give you a certificate of incorporation, and this is available from the once it's approved and filed, you can download it from the website of the state agency, usually the Secretary of the State of Office. So once you have this articles of association, a certificate of incorporation is available for download from the office of the Secretary of the State. Same process is with the LLC. You need to have the articles of organization filed with the state Secretary of the State. Once it's approved, you will get a certificate of incorporation. Now, employer identification number, as I say, is the primary IRS identification number or a federal identification number. It is widely used and one of the primary identification document here. Like in India, we are using PAN or Aadhaar. So it's equivalent to the national identity for the any way one trying to do a business in United States. And not only this, the person, the responsible person of the company, let's say whoever is responsible as a compliance officer or a designated officer for doing compliance, that the EIN application. So that person needs to have either, and that person needs to be an individual. So EIN application requests the name, taxpayer identity. So first of all, EIN, you need to apply in a specific form, which is called a form SS4. Once the company is there in SS4, you fill all the particulars about your company, incorporation number, your details, address details, type of business, etc. And upon filing of SS4, it also requests that you to designate a person who is responsible for compliance of the company. So that person is called as the responsible person who controls, manages, or directs the entity. And that person has to be an individual, and he must hold either a social security number, either a taxpayer identification number, or employer identification number. Now, from an Indian point of view, let's say if I'm setting up a company in US with Indian set of shareholders, so social security number is generally not available to the Indian shareholders unless they are the green card or the citizens of the United States. But if you do not have social security number, you can have the income tax individual taxpayer identification number. And individual taxpayer identification number once you have it, you can apply for a EIN as well. And individual taxpayer identification number, you can apply either online if your company has a business address in US, or if you do not apply for ITN or a social security number, you can request for by mail or fax or phone if you have a US business address there. So once you have a US mailing address, you can choose to apply for the responsible person, that is the, let's say, directors EIN, using either a online mode through ITIN, or using an offline mode by using a mail or fax using the US mailing address. Now, the last step is generally the setting up the bank account in United States. So bank account setting up is typically, if you go with the, so there are two options generally people follow. Let's say one is your digital bank account, like a Mercury digital bank account, or uh, there are some startups or fintechs also in US that offers the digital bank account or a new bank account opening services in like Revolut over there. But over there, the process may be a bit relaxed, but if you go with the traditional banks like Wells Fargo, JP Morgan Chase, the big bank, Citibank, the HSBC, they usually ask for too much documentation. And honestly, we have seen that the process, it takes a bit of time nowadays to get the bank account open, because there has been increased uh, KYC risk being highlighted by banks on account of black money and money laundering coming in. And also US has its act called USA Patriot Act. So it's taking a bit of time. So my request or advice, practical advice here would be to get your documents ready with notarized and apostillization wherever needed, so that clients generally do not uh, feel that this document is not needed, but generally it creates a lot of trouble at the later stage when the company is incorporated, everything is done, but you don't have your bank account functional. So this part of the documentation is also very important, and you should make your client sensitized that the documents are indeed required in United States for filing and getting the bank account number. As I said, the licenses and permits are the required based on the company's business area and the state in which it operates, like casino business or a manufacturing business or a pharma business, or let's say food business. You may be required to have a separate state license or a business permit. Now coming to the types of the taxes in general in US, like in India also we have different levels of taxes. One is the income tax, then one is the indirect taxes like goods and service tax, then we have individual income tax, then we have social security taxes in the form of provident fund, employee pension scheme, national pension scheme. Similar in United States, we have different forms of taxes. So sales tax and use tax are the indirect taxes in US. Now, very interesting to note that in USA, sales and US tax, these are non-creditable taxes. Like in India, we used to have sales tax prior to VAT, wherein tax is charged, but no credit is available, and tax is charged only at the end user level. For any subsequent intermediary sales, we used to have a concept of Form C to exempt the B2B or inter-business transaction, because the tax should be only on the end user. Similarly, in USA, sales tax is an end user tax with no credits available for the transactions in between, and the business to business transactions can happen with tax exemption, provided the another business provides the exemption certificate to the seller party. Use tax is nothing but on those transactions on which sale tax is not charged, use tax is levied. Income tax is said, as I said, is the federal income tax and the state income tax on individuals as well as on the businesses. Then employment and payroll taxes, these are social security taxes, Medicare taxes, unemployment taxes, which are some taxes are shared equally by the employer and employee. Some are paid just by the employer and some are just by the employee. So here is the uh, a breakup of more granular breakup of the payroll related taxes in United States. So one is the tax withholding, which is like a TDS or a salary to TDS. It is deducted from the salary of the employee. And at the end of the period, employee gets the form W-2 on the basis of which you file the form 1040. FICA tax is federal insurance contribution, is social security and Medicare taxes. And it's a federal levy and it's paid by both employer and employee based on a certain percentage is defined in this act. Again, this is additional Medicare taxes and it's a federal tax and it's paid both by employer and employee. The employer pays a matching amount and employee also pays a matching amount. FUTA tax or other tax is the Federal Unemployment Tax Act. It is this amount is used to pay compensation to those unemployed people. You have seen that in COVID, US paid a lot of amount, $1,000 checks, $2,000 checks to people who have lost their jobs during pandemic. So this Federal Unemployment Tax Act is the to fund those distributions. The government collects these federal unemployment tax from the employers, from all employers. Self-employment tax is primarily for those who are not in a regular employment, but in their own employment. Unemployment insurance tax, disability tax insurance. So these are also other federal and state equivalent taxes. So we have seen the federal taxes up to here. Similarly, unemployment insurance is the equivalent of the federal tax of the unemployment nature. It's levied by the states. Disability tax also, like additional Medicare tax, it's equivalent to the Medicare. And some states also have workers' compensation tax, provides temporary benefits to workers for work-related illness or injury. So it's also state taxes. Then state income taxes, we have seen that it's also a equivalent of the federal income tax. There is a state income tax. Now, I'll just take briefly a couple of slides on the sales tax because this is a bit of important because whenever you come to United States and sell your goods or services, you may be subject to the sales tax in United States. And as I said that in United States, the concept of sales tax is a bit different from the concept of GST and VAT that we used to have in India, because in GST and VAT, you will get the credit of the inputs and for the purchases you made. But in United States, there is no concept of credit, and instead there is a concept of end user tax, and all the subsequent transactions in between the end user, it can be exempt if you provide an exemption certificate. So the tax system is way back, like up to sales tax regime we have in India. And in United States, the sales tax system is extremely complicated for the reason that sales tax is a state levy, not just state levy, it is levied at a county level, at a district level. And in United States, if we take total of all the sales tax jurisdiction, it roughly comes around more than 14,000 tax jurisdictions. So more than 14,000 tax jurisdiction means for each tax jurisdiction, the tax rate may vary. So it is very difficult to manually or humanly track, and that's why we have automation tools like Avalara, Stripe, TaxJar, Vertex, which gives taxpayers help to simplify and accurately calculate their sales tax liability. There are 5 states in United States which do not levy the sales tax, 5 states and 1 district. So these are Alaska, Delaware, Montana, New Hampshire, and Oregon. So these states do not levy any sales tax. Now, there is also a very important concept called a nexus or sales tax nexus. This is very relevant after the judgment of Wayfair pronounced by the United States Supreme Court in the year 2018. This is relevant for particularly those businesses that sells in more than uh, one state, not only in their one state in which they have the manufacturing facility, but let's say you have uh, your business is in Ohio and you sell through Amazon, because this is pretty common. Indians and most of the businesses are now doing business on Amazon, Shopify, eBay, or Walmart. So through their online channels. So when you say do business through online channels, let's say you have warehouse in one state and mm, now you are selling it to other customers in California or so. So if you have a multi-state presence, uh, you are supposed to get yourself registered in each of the state in which your goods are being sold and charge sale tax from that customers. And there are certain thresholds that have been defined in each state's law based on which you are required to get the registration. Let's say the threshold could be, let's say if I'm a business in Ohio and I'm selling to a customer in California, I will be required to get myself registered under sale tax law of California if, let's say, my sales in California exceed $100,000 or $200,000, or the number of customers or the number of transaction exceed, let's say, 500 or 1,000 or 2,000. So it depends on the thresholds, the way they have been defined in that particular state law. So the practical tip here is that you need to, whenever you are doing a multi-state business in United States, uh, you may be required to get yourself registered in different state law and not just the one state in which you are registered. And also uh, the rules for, especially for SaaS-based companies, license product, software license, or software technology company, the rules are extremely complicated. The way the software transactions are being characterized, it varies across the 50 states. But some states treat them as a service transaction, some states treat them as a license transaction, some states treat them as a goods, some states treat them as a like intangible transaction. So you need to study each and every state's sale tax characterization for these particular software related transactions. Now, once you have uh, once you determine that you have a nexus in that particular state apart from your home state, you will be required to obtain a seller tax registration in that particular state. For that, you need to do the relevant filings and application with the Secretary of Treasury. And it's a fairly simple process, an online process, and you can go to their website and apply for the sales tax registration. The reason being the voluntarily, or if the nexus has crossed and your uh, home state's identification document, it would be required. Now, as I said, if you are expanding your business into other states, let's say you are registered in for Delaware, but now you are expanding your business into New York or California or Texas by opening up branches or opening up manufacturing warehouses or facilities over there. uh, you can do it. You need not to register your company in each of the every state, but you need to obtain a registration which is often called as qualification. So foreign qualification means, uh, let's take an example. Let's say a company or LLC is registered in Michigan and it's doing business in another state, or let's say Illinois, and through a physical presence in the form of a warehouse or a manufacturing facility. So a Michigan LLC will be treated as a foreign qualification LLC in Illinois, and this Michigan LLC would be required to register with the Secretary of the State in Illinois to and get a foreign qualification certification. So foreign qualification is nothing but just a recognition of the presence by that other state through and they recognize it that, okay, you are allowed to do the business in this particular state, even though you are registered in your home state, but you can do a physical presence, business through a physical presence in the other state with the help of a foreign qualification certificate. So foreign qualification certificate again is applied with a certificate of the foreign state, and foreign does not means outside US, but foreign means within US but outside of the state in which you are registered. And you need, and it's pretty much the process is done through a registered agent. You assign a registered agent. You also need to apply for a name in that particular state, and you need to obtain a certificate of good standing from your previous home state that, okay, you have not done any violations or non-compliance, and you are a good standing certificate, and you can uh, obtain a foreign qualification in the other state. Now, so what could be the professional opportunities in the business setup uh, which we have discussed so far, and we'll discuss more on during our Q&A and panel session as well. That as an Indian chartered accountant, you can obviously help your client in first, as I said, uh, evaluating the structure of the business, whether to go for a C corp or LLC, evaluating for a state in which they should form their entity. Then you can also do a drafting of the basic documents like operating agreement, bylaws, articles of formation, and obviously this work you need to do with the help of a local CPA or a lawyer with there, because because you need a registered agent to be there for doing all your compliances. But from India, sitting here, you can do a lot of legwork which is required. You can register your client with your tax registrations, do the tax filings, payroll processing, and so all this maintaining the books and the accounting, compliance point of view. You can do the annual filings, franchisee tax filing, maintaining the tax returns, social security taxes, and the payroll processing. So all this can be done while being, you can be in India, but you will need a local CPA over there to vet anything local related compliances or local US specific legislation. But most of the work we can do from here in India, because the process is fairly transparent in English language and mostly e-filing driven. So this is from a professional opportunity. From the business setup point of view, I will take 5-10 more minutes and then we will wrap up the presentation. So this is on the recently introduced US tax reforms 2.0, also called as the One Big Beautiful Bill. So just to give a context, in 2024, Donald Trump was elected again to the as the president of the United States, and one of his important campaigning agenda was to give big relief to the American families from the taxes. And if somebody, if you know, back in 2017 also, there was a significant tax reforms were introduced or tax changes were made in the Tax Cuts and Jobs Act, which is called TCJA in 2017. And in TCJA, many important deductions were given or reforms were made. And but in TCJ, there was a sunset clause, like in end of 2025 or mid of 2025 was there, wherein most of the favorable provisions would either dilute or vanish away. So one of the objective of this One Big Beautiful Bill or the Tax Reform 2.0 is to extend the tax reforms that Mr. Trump gave in his first tenure in TCJA 2017, is to extend those reforms or make them either permanent. So we'll see what are those reforms that were made and what the reforms were made permanent. So the current status of this tax reform is as of June 17, 2025. So in United States, just like in India, we have Lok Sabha and Rajya Sabha, and then the president signing the bill to become act. In US also, we have similar process. The lower house is called the House of Representative. So the House of Representative approves the bill on May 22nd. Then the upper house, which is called the Senate House, like the Senate Finance Committee, we have like the Indian JPC, Joint Parliament Country or Joint Drafting Committee. So the Senate Parliamentary Committee released the bill on 17th of June 2025. Now the bill will debated in upper house, which is the US Senate, and then we expect that the final enactment to have the target of the US government is to have this uh, bill in place before their uh, Independence Day, which is 4th of July. But let's see, it's one of the most tracked development internationally by professionals. So it's one of the most hotly debated topics. So let's see if you are able to make the mark by 4th of July or not before the US independence. But yeah, this is the current status. I will briefly go through some of the provisions. It's a long bill, 389-page long bill. Not possible to cover each and every amendment in this session, but I will go through some of the amendments related to individual, business, and international tax related, and some of the controversial amendments. So, for individuals, currently in current law, which is made part by the TCJA Act, there are 7 slab rates. These 7 slab rates have now been made permanent. Earlier, they were set to expire in 2025 with lower thresholds. So these 7 slabs have been made permanent with a provision that they would be annually adjusted with inflation. Currently, also the 7 slabs are also inflation adjusted, but there was a sunset clause till December 2025. Now these 7 slabs have been made permanent. Also in United States, there is a standard deduction of, let's say, 14 to 15K, and for married filing jointly, there is a deduction of 29,000K. So these standard deductions have now been made a permanent provision in the law, because earlier also they were about to sunset in the end of December 2025. So this provision has been made permanent with a provision that there would be higher inflation adjustment at the end of each year. Some new deductions, and which is very propaganda driven and very pro, are the no tax on the tips and overtime payments. So up to $25,000 of tip income can be claimed as above the line deduction. Similarly, overtime pay up to 12,500 USD can be claimed as a deduction. A very important, and this is estate tax planning. So in TCJA, in United States, if you inherit any estate from your parents or spouse, or up to 13.61 million, or gift of up to 13.61, this is called as lifetime exemption limit. This was not taxed. So from whomever you receive a gift of 13.6 million USD, it's not taxable in United States. So 13 million roughly translates to 104 crores or 110 crores in Indian rupees. And this threshold of 13.6 million will was supposed to half in December 2025, or by the end of the 2025. Now, this threshold has not only been restored and made permanent, but it has been made permanent in the form of $15 million. So up to $15 million gifts and estate can be transferred as a lifetime exemption. So this is one of the very significant planning opportunity and update that would be relevant for your clients. Now, from a business or a manufacturing point of view, there are 3 or 4 important points. One is pass-through entity deduction for sales and local taxes. Now, if a partnership pays state and local taxes, they can claim a deduction up to $40,000. Earlier, there was a limit of $10,000 on claiming a deduction of sales and local taxes, but now they can claim a deduction of up to $40,000. Qualified business income deduction, an additional, let's say, incentive or a deduction was made, like an investment allowance. So, which is roughly equal to 20% deduction was given to partnership, S corporations, and sole proprietorships, made permanent. Also, immediate expensive of call as Section 179 bonus depreciation. So TCJ Act made depreciation for certain manufacturing equipments, computers, 100% depreciation. Now this bonus depreciation has been made also permanent up to 2029, and there is a cap which has been introduced up to $2.5 million. You can claim the expenditure in the form of 100% bonus depreciation. Now, in 2022, in the Biden regime, certain energy credits, or if you perform certain renovations in your factory, you were allowed certain credits. Those credits are now supposed to be phased out by end of 2025. Certain Inflation Reduction Act credits are now rolled back. So this was introduced during the Biden era. Now, certain solar and wind energy related credits are extended also on a phase out basis, let's say 12 months from now or 16. So you need to evaluate what are those credits, and what is the timeline your client have, and if they can plan their investment in that particular manner, so those credits can still be available. So these are energy efficiency credits, renovation credits, electric vehicle credits, so stuff like this. From an international tax point of view, there are two very important measures that could have a very wide ramification. One is remittance excise tax, which is 3.5% levy on remittances made by non-US citizen, non-US green card persons from United States to anywhere outside US. So this could impact a lot of Indian diaspora over there, Indian citizens who are working on visas over there. If they are sending money from outside there to United States, there is a possibility of a 3% levy. And this is on a consumer remittances. Then there is another retaliatory tax in the form of Section 899 retaliatory tax. It is a just to give update, if I'm not sure everyone is following OECD Pillar 1 and Pillar 2 framework, but back in 2021, OECD launched two pillar proposals with the inclusive framework, it is called. And in inclusive framework, it includes almost 139 or 140 members of the globe. That includes United States as well. So Pillar 1 and Pillar 2 are primarily introduced to target the MNCs that generate high profits in the source countries but do not pay significant or very significantly low taxes. So to curb this or to target these kind of practices, Pillar 2 proposals and Pillar 1 proposals were launched. But and since in 2021, Trump government was not there, it was the Biden government. So they agreed to the OECD's proposal saying that, okay, we are now part of the OECD inclusive framework, and we are okay that United States companies pay taxes in other jurisdictions. Now, Mr. Trump felt that, okay, these proposals of the OECD are discriminatory in nature. They attack the sovereignty of the United States, and the US companies are being treated unfairly in the form of levy of the high taxes by other countries of the world. So he withdrew from the OECD's Globe deal or Pillar 2 deal. And instead, it has said that, okay, whichever country has launched these or introduced this OECD Pillar 2, Pillar 1 taxes, we will consider this country as a retaliatory country. And whenever a US company does business with those countries, we will saddle them with additional high taxes in the form of excise tax on cross-border fund transfer, whatever that happens between US to that particular country or from that country to US. Excessive transfer tax is being levied in the form of retaliatory taxes to so that because US country companies are being subjected to unfair taxes in those countries. The others are primarily a technical, like a reduction in deduction limit for GILTI and FDDI. GILTI is a global intangible low tax income, and FDDI is foreign derived intangible income. So these are technical changes. Now, some of the controversial proposals which bodies like AICP are actively lobbying are uh, the earlier version of the bill, not the June 17 version, but the May 22 version of the bill, have a provision which denies a deduction for sales and local taxes to specified service, trade, or business that includes accountants and lawyers. So AICPA is of the view that the prohibiting the deduction of the local taxes paid by these associations or LLPs, it would create a disparity. So this disparity has now been restored. Now deduction has been made available to for sales and local taxes to all the LLCs and pass-through entities. Existing excess business loss restriction. So there is a for the business losses. The new bill has made a provision wherein the business loss will be treated as carry forward, and it can be set off only against the business income but not the other income. Earlier, the business was treated as an annual. Annual is a larger pool of the losses and it can be set off against any other income. But now the business loss has been made carry forward subject to only against the business income. And contingent fee return preparers. So the bill, earlier version of the bill promotes that the tax return preparer can charge a contingent fee preparer. So AICPA is of the view that this will result in unsurplus tax practices wherein a return preparer would be more incentivized because of the higher refund, and for which he may use the unsurplus practices. Then remittance excise burden, as we say, is viewed as uh, prohibitive, and it can deter the cross-border movement of flows and small-scale low remittances or migrant workers. So this is again considered as prohibitive in nature. Now, on the advisory side, what you can do is go through these provisions of the bill. These are very interesting, and it could have a wide scale ramification both for businesses, for high scale net. As I said, like in estate planning, you have an opportunity. Like in business, you would have opportunity for estate planning, gift credits, various energy efficiency credits. For cross border immigrants, you would have a taxes in the form of remittance taxes. For cross border companies, the taxes in the form of retaliatory taxes. So you can go through these provisions, understand the use cases, demonstrate your capability, and this is one. Then client outreach. Okay, as I said, the possible your high net worth individual, small business clients says, and obviously follow these latest developments and share the client alerts or news alerts and your expertise on these areas, and you would be able to get some traction over there and showcase your expertise over there. So with this, I think I'll rest my deliberation, and I'll now hand it over to Atulji for any and ICI team for any questions we have on the chat box or our panel discussion continuing. Thank you.
Thanks, Manish, for a very detailed discussion and deliberating on the US business setup, where there is an opportunity for the professionals from here to expand their practice and go beyond the Indian territorial waters and identify opportunities to even to advise and guide their clients for setting up businesses. So while you have explained the entire the spread of setting up a company, what are the types of entities and what are the taxes which are applicable on it, so I would also like to discuss a couple of more issues with respect to the business setup in US, and maybe on behalf of the audience and those who are attending, if they have any questions, we'll be happy to take them as well later on. But having said that, in my personal professional experience, US, as we keep saying that Indian taxes are very complicated. I would not shy away from saying that US taxes
US,
are not, rather, I would not say equally, but even more complicated.
yeah,
Eh,
it's
because US has dual system of taxation. They have,
yeah,
as you rightly said, state and center. So in US, commonly they call it as federal and provincial taxation
mm,
system. So for the benefit of the attendees, so federal is the known as the central government, which actually defines, or the entire taxes which are to be levied at the central level, or what we call in India as the Union List 1, and
yeah,
the Union List 2, which is the
say,
provincial is the state government. So they have
yeah,
their own levies, and so there are a lot of complications,
yeah,
multiple tax forms. Thanks to the technology tools which are able to help us as
yeah,
professionals to comply with them. Otherwise, it is in my experience more complicated than the Indian taxation system. So we need to be very careful while we are guiding or advising our clients to set up businesses outside. I would strongly recommend to take help from the experts who are
mm,
qualified CPAs, or who are already working on this tax
yeah,
platform, because otherwise it can end up into a difficult situation for us as a professional. So because we
yeah,
are that's what the background. So with this as a set, the theme, I would try to reiterate couple of issues, so that those who have joined later, we can delve into those critical thoughts which you have already mentioned in your presentation. So my I would like to take this as an opportunity to ask you that what entity types can non-US entrepreneurs form in the United States, and how does their tax treatment differ? So what are the different type of legal entities which can be incorporated in US from India, like from India, in the sense where, because we are discussing the expansion of business by the Indian entrepreneurs who
mm,
want to set up businesses over there. So what are the types of options available as a structure, and what are the tax treatments which are applicable on them?
yeah. So uh, again, very right question, and very one of the primary question that comes into the mind of any entrepreneur looking for expanding. So as I said in the beginning, so there are, while the options are there in the United States law, but like you would have a C corporation, S corporation, LLC, LLP, and there are multiple general LLP. But if I were to narrow down it to purely from our context point of view, C corporation and LLCs are the most preferred one. S corporations, if you have all the shareholders as the US residents. But in our case, if I as an Indian entrepreneur won't be having a stake in the US company, I will be not be eligible for an S corp. So C corporation and LLCs are typically which I see people going for as their go-to option. And if I go for a tax treatment particularly, uh, I'm sorry if I have not covered this, the interplay between the India-US tax treaty and how this, the poem point of view, which you would have said in the initial context. But uh, a C corporation in United States is taxed at a federal level at a 21% tax rate. And if there is any dividend distributed from the C corporation, it is taxed in the hands of the individual shareholder as per the seven slabs we have. And if there is any capital gain from the sale of those shares, it would be taxed as per long term or short term as per the preferable regime in the United States. Coming to the fact that how, as an Indian shareholder, I would be taxed in India. If I'm a global resident, let's say I'm a resident, my global income is subject to tax in India with a provision for a foreign tax credit under Section 1991 and Article 25 of this. Now, specifically coming to the POEM regulation, Section 5 and Section 6 deems a foreign company to be a Indian resident company if the affairs of the foreign company are being managed effectively from India, meaning thereby the boards and the meetings are held in India and the important decisions are effectively held from India. With this also, there is a safe harbor threshold of 50 crore INR for the POEM regulations to apply. So in my sense, I mean, as long as you have a presence in United States in a sense that you are traveling frequently to United States for your business. You have a local business manager over there, local business partner or director over there. You would be able to manage the POEM regulations as long as proper hygiene is being maintained in the form of the decision making. So that's how the C corporation is taxed. And similarly, for an LLC by default tax treatment is a pass-through tax treatment wherein LLC is not taxed in its own in the United States. And if you are, let's say, a foreign partner of an LLC, you would be straight away taxed in your hands as an income. And so the foreign shareholder would be taxed in United States on its income as an effectively connected business income as per the thresholds given in that. Now coming back to India, being a resident of India, you would be taxed on your global income, whatever taxes that you have paid in United States as a shareholder of LLC, you would be subject to foreign tax credit. But in LLC, as I said, you have an option to treat the check the box treatment. So many times we suggest that LLC should be incorporated with the check the box treatment because Indian shareholders do not want to expose them to the US tax system because it could be very complicated at times and there may be misfilings and they may forget to file the returns or something withholding. So to avoid those compliances, if the objective of the LLC is to retain the funds for growth and expansion and not to distribute dividends, it's better to adopt for a LLC with the check the box treatment wherein it limits the tax exposure of the Indian resident in United States. So this is primarily a high level of the LLC and the C corporation with India tax treaty and the POEM regulations.
Certainly. To sum up this, so what you have suggested or recommended is that for an Indian business, it's actually the C corp or an LLC which is most suitable as a structure to be set up in US. And
Yes.
just to add on the POEM, what you mentioned that rightly that as per section 5(6), so what we need to be careful is that a foreign company, if it is controlled and managed from India, it is deemed to be considered as a foreign company for taxation by the Indian tax authorities. So that is where participants, we need to be very careful that we need to mitigate the facts behind this, that the entire control sits outside India. The moment you are, so where the brain is sitting, where the management team is sitting, if it is in India and you have merely incorporated an entity to just shift the tax incidence, it will be considered as a deemed foreign company in India. So that's the second point, very rightly said. I'll move ahead on this same discussion, Manish. So do we need a US visa or a green card to form or own a US business?
So again, the US Constitution and the US state regulations do not put a qualification in terms of the visa for a person to become a shareholder in an entity. So a person of any nationality or any resident can become a shareholder as long as they have the valid KYC documents for that country. And the most accepted KYC document internationally is your passport. As long as you have that document, you can become a shareholder in that. Now, becoming a shareholder director is a different concept, whereas working physically in the United States obviously requires you to comply with your visa and the immigration laws, which are pretty complex over there. But two of the common visas which we see people are EB-5 or an investor visa. Let's say you put 5 crore or 10 crore visa, buy an immobile property or a manufacturing facility over there. United States give you a visa to work over there for 10 years and period. Similarly, EB-5 is a business visa over them. So you need to obviously have the relevant visas in place to be physically present in United States and work over them. So shareholding and working physically are two different things.
Okay, so this means there is no nexus between the residential status of an individual and the incorporation of a local entity in US. So they
Yeah.
are mutually exclusive, and an Indian can definitely own a company or a legal entity in the United States.
But just to add, sorry, you can own a company, but in India, from a tax return point of view, you need to be able to disclose it in your foreign asset schedule in reporting and wherever in your FEMA foreign asset liability return, you and in your ODI compliances, you need to do that. So needless to say, we are not dealing much on the Indian compliance point of view, but this is a
Absolutely.
requirement.
Yeah, yeah. Right now, our focus is more on the US, but that having said all that, we need to be careful that all the Indian compliances are well taken care in on the hindsight. So,
Yeah.
continuing with the same thought process on compliances, like we are being professionals, especially tax professionals, we are always very careful on ensuring that all the compliances are done well and they are up to the mark for our clients, and that's
Mm.
what our endeavor is, and that's what our motive is. Now, since we are based out of India, and there are multiple compliances which are applicable in US, how do we make sure, or we ensure that the ongoing compliances which are required to be done in US are in good shape and standing?
So I think one is obviously your professional knowledge and skepticism is there, but now the tax world is evolving so fast and the developments is hard to pay. So obviously you need to have uh, a good subscription of the news or the database to keep yourself tap on the latest developments and happening over there. One resource, obviously, I'm not promoting any particular accounting body or over there, but you can obviously have an AICPA tax section membership, which is available to all of the people. It's a paid membership. Even a student can or an affiliate body member can own an AICPA tax section membership. You would have all the practical resources in terms of your year-end tax compliances, your quarterly compliances. So the compliances are numerous in terms of they vary quarterly, monthly, and yearly in terms of your tax filings, your tax deposits, and there are some event-specific tax. Let's say you're doing an M&A, the change in shareholding. So these are all the filings, but you definitely need to consider the US tax news like Bloomberg or some other database which you can keep a tap of the recent developments over there.
Yeah, that makes sense. And another question which is coming to my mind is with respect to the jurisdiction. As you were explaining during your presentation that there are multiple states in the United States, and they are all considered as different legal entities. Like we experience this now in India also, where all these states are actually contesting with each other to attract maximum business and have maximum inbound investments. That's the same trend which is there in US also. So how does as a investor or as a professional or as a corporate, if I have to take a decision, which is the most promising state, considering various aspects which may be related to the logistics or maybe the tax environment or ecosystem? So considering your vast experience, what do you suggest and recommend that which are the 2, 3 most promising states in the US?
So I remember a very interesting, if people would have watched a very popular series called Breaking Bad. There was one scene over there where was the lead actress was supposed to choose between 4 states. So there is a in US there is a monument wherein you can within that monument you can step in 4 states: Mexico, Colorado, Utah, and there is another fourth state. So uh, and you flip a coin over there, and whichever over there the coins gives, you go to that particular state. So that was the scene. So but it's not that kind of a thing that you flip a coin over there, but so it's a variety of factors, I would say. If I were to give a very broad example, let's say a tech based startup looking for world class investors and going to expand, and over there the go-to choice would obviously California over there, because California is the hub for the tech-based startups, and you get to meet the investors. The laws of that state are relevant and drafted according to the startup policy over there. So it depends primarily, but if you're looking like a pure trading company or an e-commerce company having plain and simple operations, you can go for a Delaware. But if you are high-tech manufacturing, or let's say oil and gas company, Texas is the one of the states. But so it depends that there is no state jacket formula between all of the states. So but to my mind, as I said, the most popular state we still see despite multiple states coming up. One is obviously is the familiarity, and other is obviously we have a herd mentality sometimes. So most of the people comes and say, okay, Delaware, Delaware, Delaware. So but so Delaware obviously remains the top choice, not just because it is being used by others, but as I said in my presentation during, it's because of its advanced corporate laws, the business friendliness environment of the tax. And so Delaware, Nevada, and California are one of the popular states, but obviously people are now looking for other cheaper states like Wyoming, which is coming up over there. But it will take time to people to understand these states. But yes, so multiple options are coming up, despite the popular ones remaining their top spot as well.
Yeah, so basically there's no one single state which can be straight away recommended. There are multiple permutation combinations which have to be put in place. That's what you are suggesting, that one needs to see that what is the ask of the business.
Client. Yeah.
Whether it's more on the logistics side is the demand, whether it is on the service side or it's a tech-based company. So that is what is the main parameter for taking a decision to
Yeah.
decide, which state one should go on.
Yeah. Yeah.
Okay, great. So, and on you also, refer to the clean energy incentives during the conversation. So, can you
Yeah.
throw some more light on the Senate bill which is being proposed, and what is the their intentions behind the clean energy incentives?
So let me just briefly uh, give you an. Can you hear me?
Yeah, we can hear you. There's some
Yes.
network.
Yeah, sorry. I was connected on the screen.
It's fine. We can see you and hear you also. You're audible.
So yeah. So during 2022 Inflation Reduction Act, the erstwhile US government, the Biden government, proposed certain energy efficiency credit. Like there are few sections, I will name a few, like section 179D, which provides a deduction based on the cost of the energy efficient commercial building up to a maximum amount of $50 to $5 per square feet. So whatever energy efficient measures. So this is overall part of the ESG. If we go to ESG is environment, sustainability, and government. So the more you do to reduce your energy and carbon footprint, the government will incentivize you in the form of a lowering your tax bill. So these credits are there. Like if you create an energy efficient, let's say solar panel, or let's say a water treatment plant, or any ways which you can reduce your carbon footprint, certain amount of, based on the per square foot, the incentives were given. That is the amount of or the quantum of the construction you did, which reduce your energy efficiency and the overall building cost. A certain percentages are given as a credit. Now, in the Senate bill, this deduction has been terminated uh, for any new energy efficient project taken after 12 months from the date of the enactment of the bill. Similarly, for houses, I would say home energy improvement credit. So let's say in US, during winters or during summers, if you are reducing your gas bill, or I mean in US, the houses are centralized heating. So anyways, in winters, if you can make your house self-heated or something like of measures or people are doing, whatever you're doing, you can get a 30% of the cost up to $1,200 as a credit. So this is also phased out in next 180 days after the enactment. So these are some of the kinds. So the section series are 179D, and then section series 25CDE, 30CD, 45CDCDW. So there are multiple series on this. So this represent basically the government subsidizing your cost in reducing the overall carbon footprint and energy footprint, which is now being proposed to phase out in next 180 days to 1 year from the date of the enactment of this new law.
So won't this actually be demotivating for the renewable energy companies, especially those who are looking at new investment? Like globally, all the countries and companies, they are.
But yeah, this is the overall feel of the United States. They also withdraw from the Paris Pact, and so we don't see. I mean, the overall theme of the United States on the overall climate support and change? Are they the supporter of the climate or not? That's the larger political question, but seems like they are not from these amendments in the bill.
Yeah, so they follow the thought process, my way is the highway.
Yeah, looks like.
So, a very interesting discussion, Manish. So, another thought which was coming to my mind was that while we expand business to US, assuming,
Yeah,
and we there are if I'm not wrong, there are about 50 states within the United States. So we are not we are not restricted to do business in any one state. So our objective and mission will be to cover the maximum possible, or the maximum customer base to have. Now, when we do plan for this also brings in the nuances related to the multi-state operations and the foreign qualifications. So,
yeah.
if you can enlighten us on this multi-state business operation model, where we are registered to begin with, we are registered in one state, and then we expand business, or do have a customer reach in multiple states. So how does this operate? And yeah.
So I have a very live example of a software company who is registered in New York, but they are selling softwares across the states, almost 50, 55 states, whatever. So, from a tax point of view, particularly, it's become very burdensome if you were to manage the compliances manually, because, as I said, there are more than 14,000 jurisdictions in which the sale tax rates vary. So you need to have the automated tax technologies tool to prepare your each state tax returns, deposit return on time, file the tax returns, manage your exemptions. So multi-state operations brings in a lot of challenges from a sale tax compliance point of view. Not only the compliance, but also the interpretation of the law perspective, that how the transaction in some state, the software is treated as an exempt transaction. In some state, it is taxed as a service. In some state, it is partially exempted. So we need to, and in some of the few states, there is no sale tax law. We call it as the nomad states. So, so and this can be managed through the help of the technology tools. As I said, Avalara, Vertex, or Show, these are the tools. Then also comes to the federal state related income tax. You need to, when you are doing your annual state tax returns, you need to apportion based on the portion of your billings that happen as a ratio, or the revenue, or a total income. You need to determine the apportionment factors for allocating your income from federal to the total each of the states in which you operate. So that exercise is also pretty complex exercise that you need to do at the end of the year. You're allocating your total federal income into different states, because in US you not only do the federal income tax but state tax filing.
Yeah,
Then also you would have the, from a mobility point of view, you would have employees in multiple states, so you need to manage the state withholding taxes as well as state social security taxes. So yes, multi-state is in itself a very complex process. You need to, sometimes you need to have a tax consultant for each of the states, or sometimes you need to have a very strong coordinated tax team to manage the operations for all of the states.
Okay. So that's what your take on this is. So I'll come to one maybe last question, and then probably we can want to give the opportunity for the audience participant questions if there is something. So with this the US tariff coming in, there we have been very often, we have been discussing amongst the professionals and the business community, especially who are doing business with US, that how does it impact the Indian exports, because this is a very vulnerable situation for the Indian businesses, especially who are doing export, and there is no clarity on the provisions, there is no clarity on the taxes which are to be levied. So what is your take on this, that how does it impact the exports from India, and which are the primary sectors? Although right now the India-US BTA is still under discussion, it is yet to be shaped up. So we have to see what really comes out of that. But for the time being, where do we stand, and what major impact it has on the Indian industry?
Yeah, so start with, I mean, this tariff was one of the primary agenda of the government the moment he assumed his office on 20th of November or 20th of January, so as to say. And he introduced this big announcement in April 2025, when he said that he would introduce punishment tariffs or retaliatory tariffs in the form of ranging from 10% as a baseline tariff and extends up to 26% for some of the sectors like jewelry, auto, and tech products. So this and some of the tariffs were put on hold for 90 days, but the 90 days period is already over now. So we are staring at a 26% tariff and a 10% baseline tariffs on most of the products in US, and the impacted sectors are not just one but almost entire, like steel sector, gems and jewelry sector. I think uh, steels, gems, electronic sector. So all of these are, I think, pretty much impacted by the increased cost. Now, where do we stand in terms of the mitigating the impact of this? I think there is not yet official clarity in terms of the timelines for concluding of the bilateral trade agreement BTA, so as to say. But some of the obvious uh, these are no fixes, but these are just a temporary, I would say, pain relief, you would say, or not a medicine. Is like you diversify your customer base. That's the one of the, if that situation is there for temporary, like conclude contracts with the non-US parties, or look within the US group, what are the countries in which US has a low tariff, export it to them, and then export it back to some other way. So you need to find the alternative supply chain means. There's one is the first is the go for a customer diversification. Then other is the go for a favorable country through which India has an FTA and that country has a lower tariff with US. That's another thing. And then the other one is the obviously bilateral negotiation. But obviously there is not any much relief or clarity. It's still a hue and cry among the business community, and that's the reason people are now, instead of exporting directly from US, some people are looking like creating a value addition, like importing. Instead of selling finished product to US, they are selling raw product from India to their distributor in US, and then doing some processing in US, so that to avoid the tariffs over there. So it's a mostly a supply chain management that one needs to look and have a detailed look at the fine nuances of the uh, uh, tariffs.
Noted. Yeah. So that's what the most burning topic as of now it is, and we still have to see the daylight on how does it really impact. So I'll
Yeah.
take some questions from the participants for you to address, and maybe I can also assist you on that to support. So basically, one very practical question from one of our colleague is about an Indian CA firm, a proprietary firm. How do they target or get global clients? So what is your take on that?
So obviously, I would say
It's actually very practical, because that's
yeah.
what we as professionals, we
Yeah.
need support
So
and
I
grow.
can, yeah. So I can give you my example. So the journey how I started is and because so obviously, you first need to determine whether you have that core competency in terms of whether you have the professional experience or not. That's a given. But I mean, you can serve the US tax market only if you have that relevant professional competency. That's a given assumption that I would say. Then once you have that assumption, or at least you have given yourself a time, couple of months or 3 to 6 months to develop that competency, I think the best way is to create a buzz or the reach out within your existing client network that you are doing this, and use the professional forums like ICI, attend the courses, and participate in the networking events focusing on the US business side or whatever the global business. That's the one wherein you can create your buzz, you can showcase your knowledge. Start using social medias like your LinkedIn, YouTube channels very actively in terms of uh, 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 demonstrating your subject matter expertise on this and writing articles in the popular business magazines. And also, and the best way I think to get the client and to work is immediately is to ask your NRI based clients, your foreign clients, if they have their requirements, you can assist them. Maybe because most of us would have any client who would have settled some part of the world, maybe US, Canada. So you can put at least your noise or buzz around there. I'm not just saying buzz or noise, but at least once you have done your hard homework and achieved your metal over there, you would be able to give good value addition to your clients, and that's how you would be do. But yeah, and then there are a lot of social media and AI tools to support you in your digital marketing journey and your outreach journey, which you can do later on when you have a sizable client base, and you can showcase. And plus, uh, don't lose the touch. Always not just go US for vacation, but you can spend few days for the business travel as well, and you would see the good results, I would say. But yeah, it's I'm sorry I couldn't say much on this because it's a very practical and interesting topic which I would love to deal with in greater detail. But yes, that's one of the topic close to me as well.
Yeah, exactly. Because and in my experience also, there is no one single,
Yeah, what
track
could
which
work
you
for.
can follow. So this it's the most toughest part is actually building business. So for even for professionals to build your practice, so you need to have maybe different
Approach, tried and tested
approach,
approach.
try, test, and you may succeed, you may fail. So keep working on that. That's what the ask is. So another question is related to the treaty between India and US. So we've been asked that whether if there is a payment being made under FTS or commission paid to US LLC by Indian company, is the treaty benefit available in this case?
Commission to pay to US LLC by an Indian company.
Indian company, and under the treaty benefit between India and US is the benefit, sorry, under the treaty between India and US is the benefit available?
I think this is the one of the most burning question per benefit of a treaty through a pass-through tax treaty, whether it is available. We have seen very few recent judgments wherein the benefit is allowed, saying that okay, pass-through entities are tax resident. But there is a controversy in a sense that Article 4 says that the LLC should be a tax resident of that particular country. But in US, the practical challenge is the tax residency certificates, because the LLCs are not paying tax on their income in US, but it's their partners who pay the taxes in United States. So that's where the controversy comes in, whether the LLCs are tax residents of US or not, because Indian government of say for the very reason that they are not paying taxes, but it's the partners who are paying taxes in US. So we will not give the benefit of treaty entitlement to the, but we have seen recent rulings in General Motors and in the past that this has been allowed. But again, this remains a litigative topic, but uh, conservatively, if you have to withhold the taxes, you should withhold the taxes or obtain a council opinion to save yourself from penalty. But my view and prudent view would be that yes, technically it is allowed, but it's a litigative view.
Right, right. I agree with that and consent to that. So me, because we are short of time, so I'll go faster on
Yeah,
couple of
yeah,
questions. So
yeah.
we have another one which says that federal income tax we can learn from IRS website, but where to get resource material on state income tax?
So state income tax is the best way to learn is, I guess, one is you go through the state websites over there, or you can go for reputed law commentaries like Tax Notes International or Bloomberg. They are the commentaries who are the have that repository of the state related laws, because just like in India, the state laws websites are not that very efficient. So we use databases. Similarly for United States, you can go through and the while the model laws remains the same, to be honest, the model tax code remains same, but to be aware of these laws and very thorough, you can obviously use for the good database. One is Tax Notes International or a Bloomberg, or you can obviously go for the Big Four's website. They have a very extensive material, or their country by country tax guides over there with state indexes. You can go for that as well.
Okay, so the next one is the C corporation similar to private limited company in India?
Yeah. Yes.
Okay. Yes, it is. So the company selling in multi-state through Amazon, Amazon will take care of sales tax for all states. But what about Shopify?
I think as the answer, it is reverse. I think Shopify is taking care for
Yeah.
and Amazon you need to do it. But irrespective of the fact, if and even in Amazon takes care of it, you still need to do the compliances, because sometimes there may be overcharge and there may be undercharge, and if that's the case, you need to still deposit the taxes for the balance. So even if they do it, you still need to make your own statements and do a reconciliation so that there is no undercharge and overcharge of the state taxes.
Yeah, I think it depends whether if you are a mediator and you are selling it to a
There is a
to-
marketplace
Yeah.
facilitator law in United
Yeah,
States,
exactly.
which I haven't covered here, but yeah, in the marketplace facilitator law, it was introduced back in 2020, wherein the marketplace were made responsible for collecting taxes and depositing with the US authorities on behalf of the seller. Just like in India, we have Swiggy, Zomato, and e-commerce operators doing tax compliances for behalf of the restaurants in India. So that's the law, but still you need to do a reconciliation because there might be some cases where they have undercharged and you still
Mm.
need to pay the balance taxes. So you need to be mindful of that. Just because you have a marketplace facilitator law, you're not 100% absolved from the liability.
Okay, so one maybe
Yeah.
second last or last, because we've almost reached to the time. So while filing Indian returns, if a person is earning income in US, but his residential status is no more resident in Indian tax laws, does he have to admit global income in India?
Sorry, he is
Yes.
not a resident of India,
Yeah,
but
he's
he's
not a resident of India. So the question is that if he's not a resident in India, does he still need to declare his entire global income in India?
No, but if he's not a resident in India, then the global income, only India source related income would be taxable. That's the
Yeah,
section 9 and
yeah,
5 principles are there.
exactly. So if while so there's another twist into this question also, that they so yes, you are right that while you are not a resident in India, you need not declare your global income in India. It is only the income which is accruing arising in India which has to be declared in India. But the second part is vice versa. Should he show Indian income while filing Form 1040 and avail FTC?
Yeah, if he qualify
Yeah.
as a US tax resident for a US
Exactly,
purpose,
yes.
his global income would be taxed in US.
Taxable. And if he has any additional income in India on which taxes are already paid, and that income is also declared in his US tax return,
Then tax credit is there as per
Exactly.
Article 25. Yeah.
Then he will be eligible to get the credit of the tax what has been paid in India while filing his tax return in US.
Yeah.
One last question I'll see. We are already there. So this is if a LLC is managed from India with minimum operations, what could be the best tax selection considering to keep profits in USA only? What will be treatment in India for such cases? Not very clear with the question. I'll repeat the question. If LLC is managed from India with minimum operations, what could be the best tax selection? According to us, I think there is no option which is given. So if you are an LLC, the platform is already defined under the US tax laws.
Yeah, sorry. Can you just repeat that question? I may have lost the.
Yeah. So this says if LLC is managed from India and minimum operations, what could be the best tax selection considering to keep profits in USA only?
I think LLC would always go for a check the box selection.
Yeah,
So that
exactly.
profits are capped in US and Indian and shareholder is not taxed on the US level.
Exactly. So there is no option which is actually given, to if it is the profits are being earned in US, it will be taxed in US. And if it's a LLC, the tax base is already defined for that, right?
Yeah. So LLC check the box option protects the foreign shareholders from the US tax exposure. So if you want to keep the profits and the tax liability ring fenced at a US level, go for a C corporation or an LLC with the check the box election.
Okay, perfect. So I think with this, Manish, we have almost reached to the end of our discussion, and a very great deliberation and articulation which you did on the US business setup. It's a very vast topic. It's unjustified to try and cover it within a window of 1 hour or 2 hours. And there's a lot of theoretical academic knowledge and practical experience which is required, but you tried your best, and I think you have given a great amount of knowledge sharing based on your experience. You very rightly covered the taxation system of federal and provincial laws, and also key aspects which are being expected to be amended through the Senate bill. I think one very important change which will probably come is on the inheritance tax, which you rightly pinned, because That's what actually, especially for the US residents, it is going to have a major impact on them.
Yeah.
It
Yeah.
will help them reduce the tax burden. In India, we still are saved from the inheritance tax.
Yeah.
I
Yeah.
for how many years, but yes, for the timing, it is there. And one more very important point which you touched upon was on the remittance of excise tax. So, especially for the Indian diaspora who are actually who have been, for last so many decades since the time Indians started moving out to US, they've been sending money to their hometowns.
Yeah.
And now with this proposed levy of 3.5%, it's going to be, an additional cost for them.
Mm.
Yeah, and last point which I will cover is related to the OECD developments in US, where the current government in US has put the step down that we are not going to participate in the
Always.
source-based taxation. This is again, attendees or participants, friends, this is a very, very vast subject and very close to our heart. We've been, studying and practicing on this for years on Pillar 1, Pillar 2. But this we still need to see the daylight on implication of the BEP Section 2, Pillar 1, Pillar 2 implications. Because once till the time US agrees to or
Yeah.
they, unless and until they don't agree to it, it is not possible for whether it is European Union or it is any of the Asian countries to implement Pillar 1, Pillar 2, because the majority of the business or the
It's from US.
corporations is from US only. So source-based taxation is shifting the incidence of tax from the country where the source of the business is. So if they are generating business from India, then the law says that you will pay taxes to Indian government. So it's going to be shifting the tax. So yeah, we need to see a lot on that, on how this development comes, whether US agrees to it or not agrees to the OECD, proposal for the Pillar 1, Pillar 2. Till that time, I think we had a great session. I'm sure the participants were able to were enlightened very well through your presentation and the discussion which we had. And we look forward to working together on this academic initiative. Thank you so much.
Thank you. Thank you, Arun. Thanks,
Thank you.
ICA.
Thanks, everyone. We can conclude the session.
Yeah. Bye-bye.
Yes.